Hello there. Welcome to Sumit Academy. I do hope that you have subscribed to my channel. Do subscribe now so that you do not miss out on my previous or future videos. In this video, we shall talk about money laundering. This is the first of a two-part series on the subject. Crime pays, and criminals naturally want to be able to enjoy their profits without worrying about the police or the courts. Money laundering, therefore, cannot be dissociated from other forms of crime. It thrives on corruption and is at the center of all criminal activity because it is the common denominator of all other criminal acts, whether the aim is to make profits or hide them. So, what is money laundering? Money laundering is the process of creating the appearance that large amounts of money obtained from serious crimes such as drug trafficking or terrorist activity originated from a legitimate source. Simply put, it is an illegal act showing the black money on which taxes have not been paid as legitimate gains by moving it into the financial system to make the money white. The term money laundering is said to have originated from the mafia ownership of laundromats in the United States. The mafia earned huge amounts from extortion, gambling, etc., and showed legitimate source such as laundromats for these monies. In India, money laundering is popularly known as hawala transactions. It gained popularity during early 1990s when many of the politicians were caught in its net. Hawala is an alternative or parallel remittance system. It is an Arabic word meaning the transfer of money or information between two persons using a third person. The system dates back to the Arabic traders who used it as a means of avoiding robbery. It predates Western banking by several centuries. Who needs to launder their money? The most common type of criminals who need to launder money are drug traffickers, embezzlers, corrupt politicians, and public officials, mobsters, and terrorists. Some experts refer to it as a victimless crime, but in reality, it is not a crime against a particular individual, but a crime against nations, economies, government, and the rule of law. How does it work? Money laundering, at its simplest, is the act of making money that comes from source A look like it comes from source B. In practice, criminals are trying to disguise the origins of money obtained through illegal activities so that it looks like it was obtained from legal sources. Otherwise, they can't use the money because it would connect them to the criminal activity and law enforcement officials would seize it. The basic money laundering process has three steps: placement, layering, and integration. Let's have a look at these terms. The first is placement. At this stage, the launderer inserts the money generated through illegal activities into legitimate financial institutions. This is often in the form of cash deposits in local financial institutions or smuggled across the borders for depositing in foreign financial institutions. Cash may be used to buy high-value goods such as precious metals and stones. This is the troublesome stage of laundering because most countries have a system that requires financial institutions to report cash transactions over and above some cutoff limit. Such restrictive provisions provoke the launderers to invent new techniques for pumping money into the financial system. This is the riskiest stage as large amounts of cash are pretty conspicuous and banks are mandated to report high value transactions. To curb the risk, large amounts are broken up into less conspicuous smaller amounts, which are then deposited into various bank accounts or by purchasing a series of monetary instruments like checks and money orders, which are then collected and deposited into accounts at another location. The second stage is layering. Layering involves transferring money through various financial transactions among different accounts in different names and in different financial institutions. Deposits and withdrawals are continuously made to vary the amount of balance in the accounts. Thus, a complex web of transactions layering one upon another is created. This is the most complex step in any money laundering scheme, and it's all about making the original dirty money as hard to trace as possible and frustrating any audit trail. Such transfers are made complex by changeover to different currencies through complex deals in stocks, commodities, futures, investments in real estate, and gold, or even disguised as payment for goods and services to give them a legitimate appearance. The third step is integration. At the final integration stage, the money re-enters the mainstream economy in legitimate looking form. It appears to come from a legal transaction. Investigating agencies find it very difficult to distinguish between legal and illegal money. This may involve a final bank transfer into the account of a local business in which the launderer is investing, in exchange for a cut of the profits, or in real estate or luxury assets. At this point, the criminals can use the money without getting caught. It's very difficult to catch a launderer during the integration stage if there is no documentation during the previous stages. Let us now look at the various methods of money laundering. Money laundering fulfills the ambitions of the drug trafficker, the terrorist, the organized criminal, the insider dealer, the tax evader, as well as many other groups who need to avoid the kind of attention from the authorities that unexpected prosperity brings from illegal acts. Money laundering can take several forms. The first is structuring. Often known as smurfing, this is a method of placement whereby cash is broken into smaller deposits of money, used to defeat suspicion of money laundering and to avoid anti-money laundering reporting requirements. A subcomponent of this is to use smaller amounts of cash to purchase bearer bonds such as money orders and then ultimately deposit those again in small amounts. The second form is bulk cash smuggling. This involves physically smuggling cash to another jurisdiction and depositing it in a financial institution, such as an offshore bank, with greater bank secrecy or less rigorous money laundering enforcement. The third form is making use of cash-intensive businesses. In this method, a business typically expected to receive a large proportion of its revenue as cash uses its accounts to deposit criminally derived cash. Such enterprises often operate openly and in doing so generate cash revenue from incidental legitimate business, in addition to the illicit cash. In such cases, the business will usually claim all cash received as legitimate earnings. Service businesses are best suited to this method, as such businesses have little or no variable costs and or a large ratio between revenue and variable costs, which make it difficult to detect discrepancies between revenues and costs. Examples are parking buildings, strip clubs, salons, car washes, and casinos. The fourth form is trade-based laundering. This involves under or overvaluing invoices, over and under shipments, falsely describing goods or services, and multiple invoicing of goods or services to disguise the movement of money. It is one of the most sophisticated methods of cleaning dirty money and among the hardest to detect. The fifth form is to set up shell companies and trusts. Trusts and shell companies disguise the true owner of money. They are fake companies that appear on paper but may not physically exist. If at all any of these exist physically, they may not be engaged in any trading operations. They are used to simply create the appearance of legitimate transactions through false invoices and financial statements. They also operate with normal processes like getting loans against securities acquired from dirty money and paying taxes on profits. In 2017 itself, the Income Tax Department had unearthed siphoning off of foreign exchange worth approximately 1,000 crores. During the investigation, the department found that 12 shell companies were floated, out of which 10 were based in Kolkata. Money was reportedly transferred to Hong Kong, China, and Singapore during April 2015 to March 2017 for import of customized software. The sixth form is round tripping. Here, money is deposited in a controlled foreign corporation ashore, preferably in a tax haven where minimal records are kept and then shipped back as a direct foreign investment, exempt from taxation. The seventh form is bank capture. Money launderers or criminals buy a controlling interest in a bank, preferably in a jurisdiction with weak money laundering controls, and then move money through the bank without scrutiny. The eighth form is the use of casinos. An individual walks into a casino and buys chips with illicit cash. The individual will then play for a relatively short time. When the person cashes in the chips, they will take payment by check or at least get a receipt so they can claim the proceeds as gambling winnings. The ninth form is real estate. Someone purchases real estate with illegal proceeds and then sells the property. To outsiders, the proceeds from the sale look like legitimate income. Alternatively, the price of the property is manipulated. The seller agrees to a contract that underrepresents the value of the property and receives criminal proceeds to make up the difference. The 10th form is black salaries. A company may have unregistered employees without a written contract and pay them cash salaries. Dirty money might be used to pay them. Other forms include making use of government tax amnesties, giving fictitious loans, and cricket betting, which is now a 3 lakh crore market. The goal of money laundering is to be able to use the dirty money for private consumption. If unable to use it openly, the traditional way to keep the dirty money near is hiding it as cash at home or other places. A more modern method is a credit card connected to a tax haven bank. So what is being done? Money laundering is a crucial step in the success of drug trafficking and terrorist activities, not to mention white-collar crime, and there are countless organizations in India and across the world trying to control the problem. State and local police also investigate cases that fall under their jurisdiction. The most important organization in the fight against black money is the FATF, or the Financial Action Task Force on Money Laundering. The international community is fighting money laundering through various means, including the Financial Action Task Force on Money Laundering, which has 35 member jurisdictions and 2 regional organizations, representing most major financial centers in all parts of the globe. The objectives of the FATF are to set standards and promote effective implementation of legal, regulatory, and operational measures for combating money laundering, terrorist financing, and other related threats to the integrity of the international financial system. The FATF is a policy-making body which works to generate the necessary political will to bring about the national legislative and regulatory reforms in these areas. The United Nations, the World Bank, and the International Monetary Fund also have anti-money laundering divisions. The elements of the crime of money laundering are set forth in the United Nations Convention against illicit trafficking in narcotic drugs and psychotropic substances, and conventions against transnational organized crime. It is defined as knowingly engaging in a financial transaction with the proceeds of a crime for the purpose of concealing or disguising the illicit origin of the property from governments. Let us now have a look at the role of financial institutions. While banks operating in the same country generally have to follow the same anti-money laundering laws and regulations, financial institutions structure their anti-money laundering efforts slightly differently. Most financial institutions globally and many non-financial institutions are required to identify and report transactions of a suspicious nature to the Financial Intelligence Unit in their respective countries. For example, a bank must verify a customer's identity and, if necessary, monitor transactions for suspicious activities. This is often termed as Know Your Customer or KYC. This means knowing the identity of the customer and understanding the kinds of transactions in which the customer is likely to engage. By knowing one's customers, financial institutions can often identify unusual or suspicious behavior termed anomalies, which may be an indication of money laundering. Bank employees such as tellers and customer account representatives are trained in anti-money laundering and are instructed to report activities that they deem suspicious. Additionally, anti-money laundering software filters customer data, classifies it according to level of suspicion, and inspects it for anomalies. Such anomalies include any sudden and substantial increase in funds, a large withdrawal, or moving money to a bank secrecy jurisdiction. Smaller transactions that meet certain criteria may also be flagged as suspicious. For example, structuring can lead to flagged transactions. Well, that's all from me in this video, the first of our two-part series on money laundering. This video is based on the information freely available on the internet. No originality is claimed for the same. I express my gratitude to all the media and legal websites for the information carried by them. The intention of this video is to prepare candidates for answering examination questions on the subject. Do like this video and do subscribe to my channel now so that you do not miss out on my previous or future videos. Till later then, cheerio.